The Unbundling of Capital, Tokenized Markets and the Rise of Global Champions. Section 1, Introduction. The capital market is changing. For over half a century, capital allocation has favored bundling. Investors didn't need to know which companies would outperform. They simply bought the index, the S&P 500, the Nikkei 225, the Euro stocks. The system rewarded size, inclusion, and inertia. As long as you were part of the club, capital flowed your way. But something fundamental is shifting. The emergence of blockchain infrastructure, led by tokenized assets, stablecoins, and open financial rails, is quietly dissolving the walls that kept capital geographically and institutionally constrained. In this new environment, assets no longer need to be bundled or hidden behind intermediaries to find global demand. They can stand alone. They can be streamed directly to any investor with a wallet and a reason. This is the unbundling of capital. And it's not just a technical upgrade. It's a reordering of who gets funded, why, and by whom. Just as Spotify turned albums into singles and listeners into curators, tokenized markets are doing the same to national economies and corporate equities. The capital playlist is going global. What emerges is a new breed of financial player, the global champion. These are companies, and by extension nations, that attract investment not because they're included in a basket, but because they earn attention and trust on their own merit. In the tokenized world, capital becomes more like a vote, and only the high-performing, high-trust assets will win. This exposition explores how tokenization is reshaping access to capital, shifting power away from gatekeepers, and setting the stage for a world where every company and every country competes in the open. Welcome to the Capital Olympics. Section 2, Prequel, Infrastructure. First, before champions could rise, the stadium had to be built. The unbundling of capital didn't begin with flashy tokens or viral stock picks. It began with quiet infrastructure work, the slow, methodical layering of digital tools that would one day make frictionless capital flows possible. At the foundation was blockchain itself, a tamper-resistant ledger that offered something the global financial system sorely lacked: programmable trust. Bitcoin proved it could secure value without a central authority. Ethereum showed that financial logic, loans, swaps, collateral, could run on open rails. These were not just currencies or assets. They were infrastructure primitives. Then came stablecoins, particularly US dollar-denominated ones like USDT and USDC. These digital dollars became the liquidity bridges between old and new systems, allowing people anywhere in the world to hold, send, and settle in a familiar unit. For the first time, capital wasn't constrained by domestic banking systems. It was globally mobile, always on, and programmable. Next came tokenization, the digitization of real-world assets like stocks, bonds, real estate, and commodities. This step wasn't about creating new assets. It was about wrapping old ones in new containers that could move faster, settle instantly, and integrate into smart contract ecosystems. Custodians, legal frameworks, and regulatory sandboxes began to emerge to support this shift, slowly legitimizing the transition from paper to protocol. We call this progression preemptive infrastructure, the idea that foundational tools often arrive before their use case fully emerges, laying in wait for demand to catch up. It mirrors how fiber optic cables were installed long before video streaming made them essential, or how GPS satellites orbited for decades before powering Uber and Google Maps. Today, that infrastructure is mostly in place. It's not yet universal, but it's sufficient. Sufficient for assets to be tokenized. Sufficient for stablecoins to settle trades. Sufficient for wallets to hold exposure to global assets without a single bank account. The pipes have been laid. Now comes the capital. Section 3, The Great Unbundling, From Indices to Singles. Capital, like culture, used to come in bundles. Just as music once came in albums, with 10 tracks bought to access 2 hits, investment came in the form of indices. To get exposure to greatness, you bought the whole package, the S&P 500, the MSCI Emerging Markets Index, or your local pension fund's balanced allocation. This model made sense in a world of limited access and high transaction costs. You didn't know which companies would outperform, so you spread your bets. Aggregation was efficiency, but aggregation has a downside. It hides the signal. Index investing assumes every asset in the bundle deserves capital, not because of merit, but because of inclusion. Passive flows reward presence, not performance. The result? Capital gets allocated based on weightings and legacy structures, not actual demand. Tokenization changes this. In a tokenized world, assets are unbundled. Just like Spotify lets you stream a single song from a niche artist in a different country, tokenized markets let you access a specific equity, bond, or real-world asset directly, instantly, globally. You don't need to buy a US brokerage account or a mutual fund. You just need a wallet and conviction. This unbundling creates market meritocracy. The best performing companies, no matter their geography, can attract capital from anywhere. Demand becomes granular. The playlist replaces the index. Investors become curators, not allocators. It also forces a new question. What do investors really want when friction is removed? When there's no bundled product to hide behind, each asset has to stand on its own. In this environment, only the champions rise. Companies with strong narratives, sustainable earnings, and global relevance float to the top, while mediocre names drift into irrelevance, no longer buoyed by index flows or ETF packaging. The implications are huge. For companies, you must earn attention and trust, not just a spot in an index. For asset managers, the bundle is breaking. Your curation skills matter more than your size. For nations, your economic champions are no longer just local stars. They're competing on a global stage. In short, tokenization breaks the mold of passive capital. It rewards precision over presence, performance over packaging. Demand becomes atomic, and that makes capital smarter, faster, and more discerning than ever before. Section 4. The Rise of Global Champions. In the era of bundled capital, it was enough to be in the pack. A company could ride the wave of passive flows, gaining exposure simply by being listed on the right exchange, domiciled in the right country, or included in the right index. But as tokenization atomizes capital allocation, those days are over. Capital is becoming more selective, more directed, and more demand-driven. Enter the global champions, companies that stand out not just within their country, but across the world. These are not merely large corporations. They are investable brands with undeniable product-market fit, economic resilience, and narrative clarity. They have growth curves that signal future relevance, liquidity that invites global participation, transparency and governance that build trust, supply chains and markets that are border agnostic. Think Apple, TSMC, Tesla, Nvidia, Novo Nordisk. Or in other regions, Aramco, Adani, Mercado Libre, ASML. These companies are no longer just domestic leaders, they are tokenization-ready assets. The only thing holding them back from seamless global capital access is regulatory friction and packaging inertia, and both are breaking down. Once tokenized, wrapped, and tradable on-chain, these champions can be streamed into any portfolio anywhere in the world. Their value no longer depends on national capital markets, but on global investor attention. This introduces a powerful shift in incentive structures. Nations now have an interest in elevating their best companies to global visibility. Regulators are incentivized to build compliant pathways for tokenized exposure. Exchanges and custodians must evolve or be disintermediated by on-chain infrastructure. Importantly, this isn't just about the companies. It's about the nations behind them. Global champions serve as avatars for their home countries. They export not only goods, but also trust, transparency, and economic signal. A country with a strong roster of investable, tokenized companies will find itself attracting foreign capital not through diplomacy or trade agreements, but through wallet clicks. This is what turns tokenized markets into geopolitical arenas. The question becomes, which nations can consistently produce global champions? And which are left behind, propped up only by legacy bundles and capital controls? The rise of tokenized capital flows will make that distinction increasingly obvious and increasingly consequential. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Continuing the clean, voice-over-friendly format, Section 5, Nations as Platforms. In a tokenized world, a nation is more than a government. It becomes a platform, a staging ground for capital, innovation, and reputation. Just as app developers choose between Apple's iOS or Google's Android based on infrastructure and revenue potential, companies and investors will increasingly choose which nations to build in and invest through based on openness, trust, and reach. And just like platforms, nations will compete. National champions as financial ambassadors. Global champions act as flagships for their home countries, signaling the strength of the regulatory environment, legal protection, supply chain stability, and even cultural export value. When an investor in Nigeria buys tokenized shares of a Japanese robotics firm or a Korean biotech innovator, they're buying more than equity. They're buying into national credibility. Just as Tesla reflects U.S. capital dynamism, TSMC reflects Taiwan's industrial coordination. Novo Nordisk isn't just a pharma stock, it's a proxy for Denmark's public health leadership, regulatory arbitrage, and capital attraction. The platform dynamic creates incentives for nations to compete on access and clarity. Countries that streamline tokenization laws, enable trusted digital asset custody, and support regulated stablecoins will become magnets for capital. Those that restrict tokenized flows or force capital through outdated infrastructure will slowly be bypassed, like trying to distribute a hit single through cassette tapes in the streaming era. Just as corporations sought Delaware for legal protections or Ireland for tax advantages, tokenized markets will lead capital to jurisdictions with predictable, transparent, and interoperable frameworks. Stablecoins over CBDCs. The success of tokenized markets will hinge on currency rails. Investors need trusted, liquid mediums of exchange to enter and exit positions. While many governments are focused on central bank digital currencies, the real unlock lies in regulated, privately issued stablecoins. Why? Stablecoins offer privacy buffers that global investors prefer over direct surveillance. They operate across blockchains, supporting atomic settlement and composability. They are market-driven, with incentives to improve user experience, interoperability, and liquidity. The United States is already setting this precedent, with regulated stablecoins like USDC acting as the default dollar rail for global crypto finance. Other nations, like Japan and the European Union, are following suit with stablecoin-compatible frameworks. The message is clear. If you want global capital, you must offer open, trusted, and tokenized rails. Capital as demand signal. In this new paradigm, every wallet becomes a vote. Capital flows will no longer be determined by ETF rebalancing or regional quotas, but by individual investor choice at the protocol level. A Vietnamese engineer, a Brazilian student, or a Ghanaian farmer will be able to allocate capital without permission, straight into the champions they believe in. Nations that treat this shift seriously will emerge as capital platforms. Those that ignore it will find their champions invisible, unlisted, inaccessible, uninvestable. Section 6. Investor behavior in the tokenized age. When friction disappears, preference is revealed. In the traditional system, investor behavior was shaped by bottlenecks, limited access, capital controls, high fees, time zone mismatches, and middlemen. These constraints masked true demand. Most people invested in what they could, not necessarily in what they wanted. Tokenized markets remove those barriers, and with them, the excuses. Now capital can express itself more directly, personally, and globally. From allocation to curation. In the old world, portfolio construction was about allocation. How much should I assign to U.S. large-cap equities? How do I balance between bonds, cash, and commodities? In the tokenized world, investing starts to look more like curation. Which assets do I actually believe in? Which companies or causes align with my worldview, values, or goals? This behavioral shift is profound. Like Spotify playlists or TikTok feeds, tokenized portfolios will reflect personality, conviction, and culture. The passive investor becomes an active editor, even if they never pick stocks in the traditional sense. The rise of global retail sovereign wealth. Tokenization enables a new class of investors, the global retail allocator. Armed with a smartphone and a stablecoin wallet, this individual can construct a custom portfolio across geographies, asset classes, and thematic exposures, without asking permission or converting currencies through a bank. This is the bottom-up version of a sovereign wealth fund. Not a government, but a person choosing to store and express their wealth across national borders, buying into the champions they trust most. A teenager in Kenya might buy tokenized NVIDIA shares, not a local ETF. A taxi driver in the Philippines might hold tokenized gold and Tesla. A coder in India might balance Ethereum staking with a basket of energy equities. This isn't fantasy. It's already happening, in small pockets, wherever access meets belief. Investing becomes emotional and narrative-driven. When you buy a tokenized asset, you're not just buying cash flows, you're buying into a story. And stories move people. As tokenized capital flows become more fluid, investment decisions will reflect cultural affinity, such as diaspora investing in home country champions, geopolitical alignment, such as favoring free market economies over state-controlled ones, generational values, such as sustainability, decentralization, and frontier tech. This changes marketing too. Corporations will need to narrate themselves to the world, not just to institutional analysts. Trust, transparency, and visibility will become part of a company's investment proposition, not just quarterly results. The long-tail effect of preference expression. Just as streaming platforms made niche artists profitable, tokenized markets will create room for niche assets to thrive. Not everyone wants exposure to Apple or Exxon. Some will want biotech startups in Taiwan, lithium producers in Argentina, or solar firms in Morocco. This long-tail effect means a much broader array of assets can attract sustainable capital, provided they're tokenized, trustworthy, and discoverable. In short, tokenization doesn't just change how we invest, it changes why. And when the why shifts, everything else follows. Section 7, the endgame. Global capital as a voting system. Every unit of capital is a signal. It says, I believe this will endure. In legacy finance, those signals were muffled, buried under institutions, bundled products, and geographic constraints. Tokenization clears the static. In this endgame, capital becomes a real-time permissionless voting system, not just for returns, but for trust, relevance, and alignment. Performance becomes the new passport. Historically, access to capital was about location and regulation. Now, it's about performance and visibility. If a company can demonstrate strong fundamentals, governance, and product-market fit, and if it's tokenized, global capital can find it, fund it, and fuel its growth. The same applies to countries. Capital will increasingly flow not just to where interest rates are favorable, but to where the infrastructure is reliable, the champions are investable, and the narrative is compelling. The nation becomes the platform. The platform must earn demand. This is capital mobility with a memory. Every inflow is a vote of confidence. Every outflow is a warning. No more hiding in the bundle. Tokenization exposes the lazy. You can no longer hide inside an ETF or get carried by index inclusion. In the unbundled marketplace, capital moves toward earned attention, not structural placement. This brings discipline. Governments, firms, and institutions must compete for capital on merit, not legacy. The playing field isn't level. It's dynamic, always adjusting to signal strength. If you're not tokenized, you're invisible. If you're not trusted, you're ignored. If you're not liquid, you're excluded. Geopolitical consequences of capital as signal. In a world where billions of people can allocate capital directly, soft power becomes financialized. A nation that fosters global champions and welcomes tokenized investment becomes a magnet for capital. A nation that censors, restricts, or surveils becomes a black hole avoided by design. This flips the old geopolitical script. Instead of alliances determining capital flows determine alliances. Tokenization becomes a geopolitical sorting mechanism, separating high-trust, open economies from those still reliant on control and opacity. It's not about ideology. It's about signal integrity. Can the world trust your assets, your systems, your story? The tokenized world votes daily. Every wallet, every trade, every rebalance becomes a micro-vote in the global capital election. And unlike traditional political systems, this one doesn't wait for an election cycle. It happens 24/7, in every time zone, on every chain, with no middleman. This is the final unlock. Capital doesn't just chase yield, it chases meaning. And in a tokenized world, the meaning is legible, liquid, and compounding. Section 8, Conclusion. Compete, don't complain. The rules of capital allocation have changed. No longer gated by geography, bureaucracy, or bundling, capital now flows where it's wanted, and more importantly, where it's earned. Tokenization didn't just digitize assets. It rewired incentive structures. It broke the cartel of passive capital. It forced the question, if you weren't hidden inside the index, would anyone still buy you? For companies, This is a wake-up call. For nations, it's a once-in-a-generation opportunity. And for investors, it's the beginning of a new era, where portfolios are not passively managed abstractions, but deliberate expressions of a belief, trust, and vision. There will be those who resist, who cling to the comfort of old channels, legacy products, and controlled flows. They will complain about volatility, about fragmentation, about investor attention spans. Let them. The future belongs to those who compete in the open, to the firms willing to stand on their own signal, to the nations willing to build real infrastructure for trust, liquidity, and visibility, to the platforms that know global capital doesn't follow rules, it follows value. And in this new world, value has been unbundled. It doesn't wear a suit. It doesn't need an index. It doesn't ask permission. It just performs. And the world votes, one token at a time.